In the great and unforgiving business of speculation, there is an enemy more formidable than any bear raid, more destructive than any market crash, and more persistent than any period of uncertainty. It is an enemy that resides not in the ticker tape or in the boardrooms of great corporations, but within the very soul of the speculator himself. It is the subtle, corrosive, and eternally costly vice of impatience. It is this single fundamental flaw that separates the losing 90% from the professional 10%. It is the quiet and constant siren's call that lures the amateur into the rocks of financial ruin. And it is the great beast that Jesse Livermore, through a lifetime of painful and expensive battles, learned he must conquer above all others. The 90% believe that speculation is a game of constant action. Their minds, agitated by the ceaseless dance of quotations, are afflicted with what Livermore called a hankering for activity. They feel that to be out of the market is to be missing an opportunity, that every tick of the tape is a potential profit that is slipping through their fingers. They are in a perpetual state of financial motion, jumping in and out of the market, chasing small fluctuations, their accounts slowly but surely eroded by the constant friction of commissions and 1,000 insignificant losses. They are, in a word, overtrading, and they do not understand that this constant activity is not a sign of their engagement, but the very symptom of their impending failure. Livermore learned, with the brutal clarity that only losing millions can provide, that the path to great fortune is not through constant trading, but through calculated, strategic, and often prolonged periods of inaction. "There is a time for all things," he wrote, "but I didn't know it." And that is precisely what beats so many men in Wall Street. The market does not offer life-changing opportunities every day or even every week. The great primary trends, the powerful sweeping moves where the real money is made, are rare and episodic. The time in between is not for trading, it is for waiting, for studying, for preparing, for allowing the market to set up its next great high-probability campaign. The 90% lose money because they are addicted to the game. The 10% make money by treating it as a business. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The first and most common sin of impatience is forcing trades where no opportunity exists. The amateur, consumed by his need for action, cannot bear to sit in cash. He looks at a dull, lifeless market, one that is moving sideways in a narrow, confusing range, and he tries to manufacture a trade. He will buy because a stock has dipped a point, or sell because it has rallied too. He's not acting on a clear strategic signal, but on the desperate internal pressure to simply do something. Livermore knew this was a fool's game. No man can always have adequate reasons for buying or selling stocks daily, he stated, or sufficient knowledge to make his play an intelligent play. The professional, in contrast, understands that a sideways market is a fool's playground. It is a zone of uncertainty where the great underlying forces of supply and demand are in a state of equilibrium. To trade within this range is to be whipsawed, to be ground down by the market's meaningless oscillations. The professional waits. He has the supreme patience to sit and watch, to allow the market to digest its previous move, and to build the cause for its next one. He knows that his job is not to trade the indecision, but to wait for the decision to be made. The second sin of impatience is trading out of season. This is the error of being a bull in a bear market or a bear in a bull market. The impatient trader, having missed a great advance, grows frustrated. He sees prices at what he deems to be too high, and so he begins to sell short, fighting against the great primary trend. Or in a great bear market, he is forever trying to catch the bottom, buying every small rally in the belief that it can't go any lower. He is in both cases trading out of season, his actions in direct opposition to the market's great underlying line of least resistance. Livermore learned that this was a form of financial suicide. His greatest and most profitable campaigns were always conducted in perfect harmony with the primary trend. he was a bull in a bull market and a bear in a bear market. This required the discipline to stand aside, sometimes for months, until the character of the market was unmistakably clear. The 90% are too impatient for this. They must have an opinion at all times, and that opinion is so often a contradiction of the market's own clear verdict. Now Livermore was a master at reading the tape to determine when the time was right. But another of the great legendary traders, William Gann, approached this same problem of timing from a completely different and far more mystical perspective. While Livermore was the supreme pragmatist, Gann was the supreme theorist, a man who believed that market movements were governed by a precise mathematical and almost cosmic order. He combined geometry, astrology, and ancient mathematics to create a system for forecasting the exact dates and prices of major market turns. If you wish to explore this fascinating and complex world, to understand the harmony of price and time that Gann believed was the market's secret code, we invite you to subscribe to our new channel, William Gann Trading Insights. The link is in the description below. The third great sin of impatience is the inability to wait for confirmation. This is perhaps the most costly of all the amateur's errors. He may have a perfectly sound analysis. He may have correctly identified a leading stock in a bull market, but he cannot wait for the final, decisive signal. He is so afraid of missing the move that he jumps in too early before the market is truly ready. This, Livermore knew, was a catastrophic blunder. He told the famous and painful story of his own great failure in cotton. He was profoundly bullish, his analysis telling him a great advance was inevitable. But the market was dull and lifeless. Consumed by his impatience, he could not wait. He plunged in with a full line. The market did nothing. He was forced to sell at a loss. He repeated this 5 times, his impatience chipping away a small fortune. Finally, in disgust, he abandoned the trade. 2 days later, the real move began, a massive explosive advance that he missed entirely. It was $1 million lesson in the supreme and profitable virtue of waiting for the market's own perfect timing. The professional, therefore, has learned the art of the patient stalk. He does his analysis, he identifies his opportunity, he determines his precise entry point, his pivotal point, and then he does the hardest thing in all of speculation. He waits. He sits, his capital in reserve, and he watches. He does not allow the stock's preliminary tempting movements to lure him in. He waits for the final, unequivocal signal, the decisive breakout, the market's own announcement that the time for waiting is over and the time for action has arrived. The 90% lose because they cannot wait. The 10% win because it is all they know how to do. Having examined the first 3 great sins of impatience, the errors of forcing trades, of trading out of season, and of acting before a confirmation, we now arrive at the sins that occur after a position has been taken. It is here, in the midst of an open trade, that the speculator's psychological mettle is truly tested. It is here that the impatient 90% commit the 2 great, opposing, and equally destructive blunders that guarantee their eventual ruin. These are the sins that govern the management of profits and losses, the twin failures that separate the small, fleeting gains of the amateur from the great, lasting fortunes of the professional. This brings us to the 4th and profoundly tragic sin of impatience: selling winners too soon. The amateur speculator, having finally made a correct and profitable trade, is not filled with confidence, but with a sudden and overwhelming fear. He sees the small green number on his ledger, a fragile paper profit, and he becomes terrified that the next tick of the tape will snatch it away from him. He's impatient for the certainty of a realized gain, no matter how small. He tells himself the old, comforting, and fatally flawed adage: "They say you never grow poor taking profits." Livermore knew this to be one of the most insidious and misleading pieces of Wall Street wisdom. He countered, with the conviction of a man who had seen its consequences 1,000 times, "No, you don't." but neither do you grow rich taking a 4-point profit in a bull market. This is the great paradox of the impatient trader. His fear of losing a small profit is so great that he guarantees he will never, ever achieve a large one. He is so focused on the short-term battle that he consistently loses the long-term war. This fearful impatience is the enemy of all great speculative campaigns. The big money, the life-changing money, is never made in the small day-to-day fluctuations. It is made, as Livermore discovered, by identifying a great primary trend and having the courage to sit tight. He stated it as the most important lesson of his entire career. It never was my thinking that made the big money for me. It always was my sitting. Got that? My sitting tight? The impatient trader cannot sit. His nerves will not allow it. He is a sprinter in a marathon, and he is destined to exhaust himself long before the finish line is in sight. He will see a great bull market. He will correctly identify a leading stock, and he will even time his initial entry with skill. But he will sell out for a pittance, for a quick and easy gain that satisfies his immediate need for action and certainty, only to watch in agony as the stock continues its relentless 100-point march to the heavens without him. The great story of Old Turkey, the wise trader Mr. Partridge from Reminiscences, is the ultimate antidote to this sin. While the younger, more impatient traders in the office were frantically buying and selling, snatching small profits on every minor rally, the old man would simply hold his position. When urged by a well-meaning friend to sell his stock and take a handsome 7-point profit, he simply shook his head and said, with profound and simple wisdom, "My dear boy, if I sold that stock now, I'd lose my position. And then where would I be?" What he meant was that he was in harmony with the great primary bull trend. To sell now, to jump out for a small gain, would be to abandon his perfect alignment with the market's most powerful force. He might not be able to get back in at such an advantageous price. He knew that the real prize was not the 7 points he had now, but the 70 points that the great trend was still to offer. He had the intelligent patience to sit tight because, as he so often reminded the others, "Well, you know, this is a bull market." This simple phrase was the key to his fortune, and it is the key that the impatient trader can never bring himself to turn. Now we must examine the dark and paradoxical twin of this fourth sin, the fifth and equally destructive sin of impatience, holding losers too long. Here the amateur speculator who was so frantic and impatient to cash in his small profit now displays a level of patience that would be the envy of a saint. The same man who could not bear to sit with a winner for more than a day will now sit with a loser for weeks, for months, his capital and his spirit slowly bleeding away. When a trade goes against him, he is not impatient for an exit. He is, instead, filled with a sudden, desperate, and infinitely patient hope. He tells himself, it is just a temporary reaction. It will come back. He is impatient to avoid the final painful act of taking a loss, of admitting his mistake. And so he holds on, a prisoner of hope, watching the small, manageable loss that he should have cut without a second thought grow into a monstrous, account-crippling disaster. This is the great fatal inversion of logic that plagues the 90%. They are impatient with their profits and patient with their losses. The professional, as Livermore learned, must do the exact opposite. He must be supremely patient with his winning trades, giving them all the time they need to grow. And he must be brutally, ruthlessly impatient with his losing trades, eliminating them the moment they prove themselves to be mistakes. Livermore knew this from the core of his being. He stated it as the great central law of the psychological game. Instead of hoping, he must fear. Instead of fearing, he must hope. He must fear that his loss may develop into a much bigger loss, and hope that his profit may become a big profit. The sin of holding losers is the sin of allowing hope to exist in a situation where only fear is appropriate. The impatient trader facing a loss wants to get even. He is impatient for the market to reverse and restore his lost capital. This desire is so powerful that it blinds him to the clear, objective reality of the tape, which is telling him that the trend is against him. He is no longer trading the market. He is trading his own emotional needs. The result is always the same. As he waits with a saintly patience for the reversal that never comes, his capital dwindles to nothing. The market, in its impersonal wisdom, does not reward the hopeful, it rewards the disciplined. The fifth sin of impatience is the refusal to accept this brutal and unchangeable truth. Having dissected the first 5 great sins of impatience, the errors of forcing trades, of trading out of season, of acting before confirmation, of selling winners too soon, and of holding losers too long, we now arrive at the final, and perhaps most deeply ingrained of all the amateur's flaws. These are the sins that emerge from the darkest corners of the speculator's psyche, the impatient impulses that are born from a state of loss and that plague a trader even when he has no position at all. To conquer these is to achieve the final and highest level of professional discipline. This brings us to the 6th sin of impatience, the desperate, impatient need to get even. After a speculator suffers a painful loss or a series of them, his mind is no longer focused on the calm, dispassionate analysis of the market. It is consumed by a single, burning, and intensely personal desire to win back what was taken from him. He is no longer a speculator. He is a man seeking revenge. And the market, he learns, is a terrible and expensive place to pursue a vendetta. This need to get even is a particularly virulent form of impatience. The trader feels he must recover his losses now on the next trade. This desperate urgency destroys all sense of proportion and all adherence to sound principles. He will abandon his rules. He will increase his position size, making a bet far larger than his capital can safely sustain. He will force a trade in a market that offers no clear opportunity, all in the hope that a single lucky victory will erase the pain of his previous defeat. Livermore knew this state of mind with a chilling intimacy. He had felt it himself. But he learned that to trade from a state of anger, desperation, or revenge was to guarantee further, and often greater, losses. He warned of the great who-do of trying to make the market pay for a specific need, whether it was for a lost sum of money, a new automobile, or a sable coat. He wrote, "What does a man do when he sets out to make the stock market pay for a sudden need? Why, he merely hopes. He gambles." The professional's antidote to this sin is a profound act of mental discipline. After a significant loss, he understands that the most important thing to do is often nothing at all. He must step away from the market, allow the emotional storm to pass, and regain his psychological equilibrium. He knows that his lost capital cannot be recovered with one desperate, impatient lunge. It can only be recovered slowly, methodically, and patiently, by returning to his proven disciplined methods and waiting for the next genuine high-probability opportunity to present itself. The 90% try to get even. The 10% focus on getting it right the next time. This leads us to the 7th and final sin of impatience, the ultimate test of a speculator's mastery over himself, the inability to sit in cash. The amateur is a man who is addicted to the action. He believes that to be out of the market is to be idle, to be unproductive, to be missing out. He has a constant nagging hankering for activity. His capital, if it is not invested in some position, feels like a wasted resource. He does not understand that cash is in itself a strategic position, and often the wisest and most profitable position of all. Livermore knew that the great fortune-making opportunities are rare. They do not appear every day. They are the culmination of weeks and sometimes months of quiet, underlying preparation within the market. The professional speculator's job is to have the supreme patience to sit and wait for these gilt-edged opportunities to arrive. To be constantly in the market, jumping from one minor fluctuation to the next, is to guarantee that when the great primary move finally does begin, you will either be on the wrong side or have your capital so depleted that you cannot take a meaningful position. He wrote with the force of an unbreakable law, "There are times when one should speculate, and just as surely there are times when one should not speculate." To know the difference is to know the very heart of the game. The 90% in their impatience trade all the time. The 10% have the discipline to trade only when the great impersonal probabilities are overwhelmingly in their favor. The rest of the time they sit. They watch, they study, they wait. This ability to sit in cash is the source of the professional's greatest power. It gives him clarity of mind. The speculator who holds a position is always on some level looking for the market to confirm his own opinion. His perception is colored by his own bias. But the man who is in cash has no bias. He sees the market with a perfect, cold, and detached objectivity. He is not hoping for it to go up or down. He is simply observing its behavior, waiting for it to reveal its true underlying trend. Livermore encapsulated this perfectly when he said, "Remember this. When you are doing nothing, those speculators who feel they must trade day in and day out, are laying the foundation for your next venture. You will reap benefits from their mistakes. The impatient 90% with their constant unprofitable churning create the very market conditions, the tops, the bottoms, the breakouts, that the patient professional is waiting to exploit." The story of the remarkably successful speculator who lived in the California mountains is the ultimate illustration of this principle. He would receive his quotations 3 days late, and he would only come to the city to trade a few times a year. He was completely detached from the market's daily noise. He said, "I make speculation a business. I would be a failure if I were in the confusion of things and let myself be distracted by minor changes. I like to be away where I can think." Real movements do not end the day they start. It takes time to complete the end of a genuine movement. By being up in the mountains, I'm in a position to give these movements all the time they need. These 7 great sins, then, forcing trades, trading out of season, acting before confirmation, selling winners too soon, holding losers too long, the need to get even, and the inability to sit in cash, are the anatomy of speculative failure. They are all born from the same single fundamental flaw: impatience. To conquer impatience is to conquer the market. It is a lifelong battle, a constant war against one's own most natural and most destructive impulses. The path to mastery is not a path of finding a secret formula, but of forging an ironclad discipline. It is the understanding that speculation is not a sprint, but a marathon. It is the slow, methodical, and patient application of sound, proven principles. It is the profound and difficult art of waiting, of observing, and of acting only when the time is perfect. This was the great lesson of Jesse Livermore's life, a lesson that remains the only true path for the speculator who wishes to move from the losing 90% to the winning 10%. To truly understand the mind of the man who waged this internal battle more intensely than any other, to witness the epic market campaigns where these very sins were committed and ultimately conquered, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master speculator at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below.